I'm Elizabeth Warren, Chair of the Congressional Oversight Panel. I'm here to introduce our July report, Small Banks in the Capital Purchase Program. In newspapers and on television, you'll hear the Troubled Asset Relief Program, called by its better-known nickname, the Wall Street Bailout, and for good reason. TARP pumped hundreds of billions of dollars into Wall Street, in some cases saving huge banks that otherwise would have collapsed. But Congress never imagined TARP as a bailout for Wall Street. It was intended to support the whole economy, home prices, retirement savings, and banks in every county in the country. In that spirit, the panel this month turned away from the Wall Street banks and focused on TARP's efforts to strengthen small community banks. All told, about 700 small banks received $40 billion taxpayer dollars. In exchange, those banks agreed to pay a quarterly dividend until they repaid all the money. These investments were part of a broader initiative known as the Capital Purchase Program that provided funds to banks of all sizes, from the largest bank on Wall Street to the smallest bank on Main Street. After close examination, our panel concluded that the program served Wall Street much better than anyone else. Now, we should begin by noting, as we have in the past, that TARP and the Capital Purchase Program did some powerful good. If nothing else, by demonstrating that the government was willing to spend whatever it took to save the banking system, it restored a measure of confidence and it pulled the economy back from the edge of a dangerous cliff. But the program was designed in a way that lumped every bank in the country together. Every participating bank received money on substantially similar terms, a sort of one-size-fits-all approach to financial stability. Unfortunately, one size doesn't fit all, because big banks and small banks are different in some important ways. The most significant difference is that investors believe that the biggest banks on Wall Street are too big to fail. If they ever defaulted on a debt, investors believe that the American taxpayer would cover any losses. As a result, investors are much more willing to put money into big banks than into small ones. Right now, that means small banks are finding it very hard or impossible to raise new money. Without access to capital, the small banks that took TARP money will have a hard time repaying taxpayers and getting out of TARP. The problem will get worse in a few years when TARP's dividend rate will sharply increase. Higher dividend payments, combined with the strains from the recession and growing losses in commercial real estate, could force some small banks to default, so they may be swallowed up by other banks or they may simply collapse. Now, Treasury has stated that the Capital Purchase Program was aimed only at healthy banks, so we might expect these small TARP banks to outperform the broader banking sector. But this does not appear to be the case. In fact, on some metrics, such as exposure to commercial real estate losses, these banks are faring worse than those that never receive taxpayer funds. Now, of the big banks that received Capital Purchase Program money, 76% have already repaid. Of the small banks, less than 10% have repaid. In fact, 15% of the small banks have already missed a dividend payment, suggesting that they are in financial distress. Treasury still has $25 billion taxpayer dollars outstanding at these small banks, and the prospects for a full recovery are uncertain. If TARP ends up saving big banks but leaving small banks to be swallowed up or to collapse, then its legacy could be an even more concentrated and possibly more vulnerable financial system. It is also unclear whether the participation of small banks has advanced Treasury's broader aims for the program. In particular, Treasury aimed to increase the flow of credit to consumers and small businesses. But as the panel explored in depth in May, there is very little evidence to suggest that the program led to new lending. Now, we realize that this is a grim picture, but if there's good news, it is that the worst is still a few years away. Treasury still has time to plan. In the meantime, the panel recommends that Treasury support banks' efforts to raise new capital and that it should explain its process for dealing with banks that fall behind, including its policies for appointing board members. To learn more, you can read our full report on our website at cop.senate.gov. As we consider the future of small banks, it is important not to forget the reason why Congress agreed to help our financial institutions. TARP was not intended to protect any specific bank, large or small. It was meant to sustain our economy and to protect you and me and our families and our friends. So long as small banks remain weak, their lending will remain constricted. Without loans from small banks, some small businesses won't be able to borrow money to keep their businesses operational or to take out a loan to hire new workers as the economy struggles to expand. So long as that is the case, TARP's work will remain incomplete.